Well, we have been watching the surge in technology stocks this year. A lot of that is tied to the AI boom, and at the center of that boom is the AI chip darling Nvidia. And we mentioned we've got some news on the company today, with AMD and Nvidia agreeing to pay 15% of revenue for AI chip sales to China that's payable to the U.S. government in exchange for export licenses. Wall Street is reacting to this story, and it's somewhat mixed. On the one hand, it allows the companies to sell into that market, as Bernstein noted, but at the other side of it, even the same analyst team saying they're not sure they like the precedents this sets. Wedbush adding to that, saying the precedent is worrisome, given it opens the door for the U.S. to selectively tax a variety of companies that are leaders in technology. Dan Rohinton is a portfolio manager at IA Global Asset Management, and he joins us as part of our opening bell coverage. And Dan, I guess when we're talking about two companies that have been at the center of the tech surge this year that are trying to make their way back into the Chinese market, what's been your general takeaway on the deal they seem to have reached with the U.S. government here?
I think it's a bit odd more than anything, because you can really think of the H20 chips and the equivalent for AMD, but also let's not forget Avago, which has ByteDance as one of its rumored custom ASICs customers. Really, the question is, I thought, really bifurcated. Do you want to allow proliferation of American technology all around the world and be the default standard, or do you want to sequester China? This is this weird middle ground where you basically get a royalty as the U.S. government for part of the chip program. So it works out to probably a third, if not maybe half of the actual profitability on a per unit basis of the chips. So I think puzzling is the right answer, although I would also say this is not some panacea consequential dynamic, because let's remember that there isn't the vast majority of the revenues for Nvidia, the hopes that AMD has that they're ramping this up, and Avago really sit within the US and the rest of the world. So China was already building out their own native ecosystem. I don't think that really changes this conversation. So let's leave this in the question mark column in terms of what drove this decision.
Well, and I think one thing worth highlighting with Nvidia as well, like it's not a company that has spent a lot of time lobbying in DC compared to a lot of other Silicon Valley companies. But in light of this situation, we were hearing a lot more about Jensen Huang making visits to the White House to try to at least keep the door open for the Chinese market. I guess given the run-up that we've seen in stocks like Nvidia, because I think as an investor, this is a name you've had in the portfolio. How do you think about how investors are going to measure the stock and any headline around it after the run it's had?
Yeah, I think the question around the reaction today is really inconsequential in the grand scheme of things, given how the stock's basically almost doubled from the deep sea lows and the Liberation Day lows of the market. So really comes down to what you think forward expectations are. So we already know that the builds on the data center side are taking place, because the announcements and the CapEx programs for this year and next year are largely in place amongst the big clouds. So think of your Microsofts, your Oracles, your Googles, your Amazons, and what have you. The question is the year after that. And for there, you need to really think about token usage. And I mean inference, which is practical uses of these tools in our day-to-day lives. And we already know the distribution mechanism, John, because it's the Gmails, the Outlooks. It's already the apps we already have. But are they seeing native utilization of AI features within there, which will drive up tokens and then backfill the demand for the 2027, 2028 cycle for NVIDIA earnings? So it's not about this year. It's not about next year. It's about what comes from that. And I think that key leading indicator will be inference across the big clouds.
All right. Now, when it comes to stocks in tech that have had a big run over the long term in Canada, oftentimes we talk about, Shopify, which has been on a tear recently. Constellation Software is another company that gets a lot of attention and a unique name in that they reported their quarterly results on a Friday night. But there's a lot of things that are unique about Constellation, including its longtime leader. And I wonder, when you're looking for investment opportunities in tech in Canada, do you see an opportunity similar to what you might see in the United States?
Nowhere close. And Constellation is in a rare breed. Speaking of rare, Mark Leonard's beard is something to behold in his own right. But what I would say is Constellation is a marquee Canadian tech company, but what they do is fundamentally different than what Shopify does. So this is the type of business that acquires, basically call it legacy software, and rolls it up, because the thesis behind what Mark Leonard has built over the last 20 years has been that the stickiness of software effectively means that if you pay the right price for these companies over time, that this annuity stream will continue to build and grow. So what's unique about this quarter for Constellation is that we saw faster organic growth, but it's still on an aggregate basis quite low. So that Constellation thesis is a unique one, and ironically a very Canadian one, because Canada has a lot of roll-ups in it. This just happens to be the most successful tech version of that roll-up.
All right, good to get some perspective from you on the Constellation software story. Dan Rohinton, portfolio manager at IA Global Asset Management.